Ted Oakley is back. He is a founder of Oxbow Advisors, and he'll be discussing with us his macro outlook as well as how investors should be positioned now in light of a lot of important economic data that's come out in recent weeks. Ted, welcome back to the show.
Thanks, David.
Ted has called for the markets to go down even further, the stock markets in particular, and we'll talk about some of these risks that he's highlighted in previous appearances with us. But first, let's talk about some recent news that have investors on edge. House Speaker Nancy Pelosi landed in Taiwan this week, and she's actually met with the Taiwanese president. The Chinese government has responded not so kindly. They've said that this is extremely dangerous. They've condemned the visit, and they have responded by ramping up their military drills in the South China Sea. Now, this visit has been thus far unofficially sanctioned by the White House. The White House has not officially approved of this visit, but Nancy Pelosi is here nonetheless. The question investors are wondering, Ted, is whether or not things could potentially escalate out of hand and cause further market turmoil.
Well, you know, David, I'm not concerned about particularly Nancy Pelosi being there. I'm not certain, and I'm not certain anybody else knows why she's actually there. Maybe it's a constituency thing. Nobody knows, really. The only thing about what's going on now with China is I'm sure they're keeping an eye on what's going on with Putin and Ukraine, because if that continues to go toward the benefit of say, Putin, and he pulls that off, then you got to figure that China's going to look at Taiwan and say, well, you know, nobody's doing anything, so we may use this as the point. And I remember everybody saying that about Hong Kong, like they'll never really take Hong Kong and change their will. That all happened, and it's a totally different place today. So I think that's what you have to watch out for, is what, because I think they view us as being fairly weak in terms of something we would rely on. So it'll be something to watch. Several important notes to mention coming from this meeting. First, the market seemed to largely shrug off any escalations, at least for now. I'm looking at the charts today. As we're speaking on Wednesday, the S&P 500 is already up more than 1%. So clearly investors at large aren't really that concerned. Or maybe, Ted, as we spoke offline about this possibility, maybe a potential war could be positive for the markets. What do you think? Well, I don't think that war would be positive. I mean, I think it would be something like World War II, where your trade partners get really all discombobulated, and all of a sudden everything gets messed up economically. And I think that's a totally different thing than the Ukraine war. So that would be one where I would not expect that to be a positive.
Okay, so if that weren't positive, then okay, so we'll come back to the markets. Another thing that Nancy Pelosi said that was interesting was that she reassured the Taiwanese president, the Taiwanese delegation, that the Americans would back Taiwan should China apply more pressure to the island. In her words, were the Americans would not abandon the Taiwanese allies. What does this mean in the grand scheme of things, Ted?
Well, I don't think it means a lot, because she doesn't have the power to do that, number one.
Okay.
And number two, if she's so keen on backing people, why wouldn't she step in and help Ukraine? I mean, you know, I think that's just talking. I don't think there's anything to that at all.
All right. So bottom line is that you don't think tensions with China right now would really escalate to the point of no return. This meeting really doesn't have any detrimental long-term impacts on Sino-American relations.
Well, I think the detrimental impact is that, you know, the next time he sees Xi, he's going to have to, you know, defend her going to Taiwan, and saying, he's probably going to be saying, well, wait a minute, let me ask you what's going on here. I mean, something along that line. I don't have any idea, but again, you know, it's very unusual for somebody like her to take this type of trip, and I don't think anybody knows why she's there.
Okay. Well, the markets certainly have reacted to many things positively over the last month. If you just take a look at the 1 month chart of the S&P 500, it's been up. Well, this is surprising considering that second quarter GDP came out just last week and was negative, and the Fed has raised rates by 75 basis points the same week that quarter two GDP came out as negative. Do the markets, are they, first of all, are investors interpreting this as good news, Or perhaps this was already priced in?
Well, I think what investors are missing, they're all in a hope game right now. I mean, if you look at portfolio managers are all down for the year, and a lot of them are really down.
Yeah.
And they really want this to be the low. I mean, I've seen so much talk about the low the last 2 weeks that it's unbelievable. I mean, in print and networks, et cetera. But the problem is we haven't even gotten into the bad earnings, which is over the next 2 or 3 quarters. So that's not even factored in at this point. And it's not unusual. And we had a big rally in March, if you remember, very similar percentages, by the way. We're up about 14, maybe 13.5, 14% on the S&P from the June low and up 18 or 19 on the NASDAQ. However, you have to remember the NASDAQ is still down 23 or 24 from the high. S&P is down, very similar. So it's one of those things that fakes people out. They think it's okay, and we're going to turn the corner here, but it's not unusual to have bear market rallies and then resume somewhere, which I think you will do, because I don't think they've factored in anything regarding poor earnings that are coming out.
Okay. Well, let's talk about that right now. Poor earnings that are coming out. Why are you assuming that poor earnings will come out?
Well, look at everything that's put in place here. Okay, look at just take, for example, their higher cost of capital. Number one. Number two, look at inventories. Inventory is a 38-year high, David, 1984. And you've got, when you look at orders down, inventories up, these are going to affect these companies. Look at the big companies telling you that business is slowing down. They're laying off workers. I mean, the real big tech companies doing this. And yet they've been able to, work around it with their earnings and really, they're fairly unregulated now relative to what they want to print, but they can't get away from the next few quarters, because what you're going to have is you're going to have a situation where the recession really takes hold. And when it does, those earnings will have to come out. See, Wall Street loves to hold the earnings high until you get to the bottom, and then they cave. That could be a year from now. But the point is, they still have the earnings in the S&P up 10% this year, and we don't think there's any way that can happen from this point forward. So they're saying, hey, we're at a 16 multiple. Not really. If you have what we expect the next 2 to 3 quarters, you're probably at a 22 or 23 multiple right now. You're still not, you're still not cheap, but that's Wall Street, and that's what they get paid to do. They get paid to sell good news.
Yeah, I think it's a good point, and it's important to note that the last quarter of earnings that came out, the percentage of stocks that beat analyst expectations were lower than usual by historic standards. So that's certainly not a positive trend in that direction. Now, I'm looking at the chart of the S&P 500's performance over the last 70 years, going back to the 50s, with the Ember shaded recessions. And in almost all recessions, not all, but in almost all recessions, the stock markets have declined. There were a few exceptions, but they've declined throughout the entirety of the recession itself. Let's comment on that fact first and foremost. 2020 was an anomaly. We saw a very, very rapid V-shaped recovery following the March crash. But what's going to happen this time, Ted? How do you think the stock markets will respond to this recession? Will they follow history? Will the stock markets follow history, or can this time be an anomaly?
Well, I think, David, the difference this time is you're coming off of the all-time greatest bubble in everything, not just stocks, but everything. And when you have that happen, it takes a long time to wring it out. And I think what people are thinking, and see, you have to remember, you have over 40% of the people in this industry have only been around for 12 years. So they don't really know what it's like to go through a super slowdown. They haven't seen it because the Fed's always bailed them out. Now, if you're going to have that coming up, we think the problem with that is that this one will, yes, go deeper, and certainly deeper than 20% on the S&P is what we think. And that's why we're really liquid right now. But, that's what makes a horse race, I guess, David. So, but that's what we're thinking.
Okay. I know nobody knows the answer to this question for sure. Nobody has a crystal ball. But if you were just to speculate as to how long this recession could last, what would you say? Keep in mind that the last technical recession was 2 years ago during COVID. That lasted 1 quarter because we did have a very rapid rebound right after. The one before that was 2008. We all know what happened then. How deep can this one go?
Well, I'll give you an example, and I think this is what will throw people right here. If you look back at 2000, I remember this. The GDP actually went down less than maybe 1%, but that was just in the beginning. And the market fell another 48% or so. So what happens is they will misinterpret this. And what I think will happen, even if you ended up being, even money on the next quarter or two, or maybe barely up, over a 4 to 6 quarter period, you have to expect that 3 or 4 of those quarters are going to be negative. And I think that's got to last. And to me, that lasts a minimum to the end of the first quarter, maybe, because that's only 3 quarters away. So I can't imagine that we pull out of this whole thing after this incredible bubble, in a 6-month deal, and we turn the corner and everything's fine. We don't look for that.
So let's assume it lasts for 3 quarters then. Now, again, going back to history, usually in prior recessions, the stock markets have rebounded have started to rebound towards the end of the recessionary period. In other words, the last inning of the recession. If you assume that this recession will last 3 to 4 quarters, would it be fair to say that by this time next year, Ted, would be a good time to redeploy capital?
David, I would expect so. I mean, I think you could get somewhere in the next 6 to 12 months, you could get a really great buying opportunity. Mm-hmm. I suspect that'll happen. I mean, it usually happens in this sort of atmosphere we're in right now. And by the time you get there, it want to be one of those things where right now people are just thinking, when can we go up and should we buy more? When you get to the low in the market, they're disgusted. They don't even hear the word stock.
Well, it's interesting how timing is difficult, because once you're at a low, sentiment is so weak that, like you said, everyone's disgusted. Nobody wants to even think about getting back into the markets, but historically speaking, those are probably good times to get back in. But you're saying that before we get a rally, we could possibly see another 20% correction, right? Just to sum up?
Oh, yeah. From here?
Yeah, from here.
Yeah, because we just rallied about 13.5 or 14. For us to go down another 20 or 30 would not be hard at all, actually, when you look at what the earnings are going to look like the next 2 quarters.
Okay. All right. Well, let's turn to specific asset classes that you like or dislike. Bonds, with yields ticking up, how do you feel about fixed income?
Well, the way when I'm going to give you an example we get new money in every week, and I'll just give you an example on the fixed income side, what we do right now. Okay. We're doing a couple of things, but we have put on, I'll just give you an example. We probably own 5 to 8% long-term on the long-term treasury, because we think with the curve steepening, that long end will go down. On the short end, what we do with a lot of money right now is we've got it between 6 months and say 2 years, maybe 2.5. And those yields right in there are really good yields right now. I mean, compared to what we have been getting. So we put money in there. And then on the other side, we'll go out and pick up. We still like the preferred market. Now, the preferreds have bounced in the last month. Okay, I will tell you. But if you can still get 5 3/4 to say 6.25% on preferreds, for us, that's particularly on the really too big to fail banks and that kind of thing. That's a better buy than buying a corporate bond. So we mix those two a little. Don't own a ton of that, probably not more than 10% of those, but that's how we set up a fixed income account for the time being, because we want to be able to make some adjustments, because once we feel like the curve is extended as far as it's going, we will adjust out and buy longer paper. Now, I will tell you what happens in those cases, because I've been around during that time in 82 and 83 and 84. People will think you're crazy, because they're like, hey, I can get more on a 1 year or 2 year than you're buying from me on a 10-year or 15-year. But what they don't realize is that's right before the curve breaks down all the way. And so we're not there for us yet, but that's what we'll be looking for.
When it comes to maturity, would you be short duration right now?
We're more short than long, yes. Yeah, we're 80% short right now, 75 to 80. Hasn't cost us anything. I mean, what happens is we came into the year like that. We got hurt a little bit with the loan paper, but still we're well ahead of where we would have been had we kept a normal portfolio with, say, an 8 to 12-year duration. We don't have that right now. Not that we might not get that later on, but we don't have it right now.
It's interesting how people were searching for yield in the last decade when yields were so low. People were rushing into perhaps even high-risk debt from the corporates. So, like the below investment-grade corporate debt. How do you feel about that asset class right now that we may be heading into a recession?
Well, I don't think you can buy high yield here, and I think there's so many companies in that group that issued so much bad debt, and Wall Street let them do it. Okay. And that debt is yet to flip and throw up, but it will. It'll come around. And so if you're looking to do something, don't look to high yield. I think that the junk market will really mess you up in here. When you want to buy junk bonds is when you buy the stocks. They both bottom together. And I've done that maybe a couple of times in the last 25 years, but that's what you look for. They'll get real cheap at the low in the market, then you look at it. But right now, I'll give you an example. We own a lot of the variable rate treasury. It's a 90-day variable, but a year ago, that was yielding 5 basis points. Today, it's 246.
Yes.
So you can see what happens in a short period of time. So you have to stay nimble on these things.
True. Recession, generally speaking, recessions are difficult to invest in when it comes to economic periods. Like you said, the stock market could see a further correction. High yield debt is not a great place to be. Where do investors go then, Ted, to find yield right now? Are there certain sectors that might perform better, certain asset classes that might perform better during a recession, I mean?
Well, I think what happens, David, if you're in the stock market, even things that have higher yield in terms of common stocks or preferreds, they typically are going to get affected too in a really bad bear market. You have to be able to adjust some things, and for us, the adjustment we make is we carry a lot of liquidity. By that I mean we're 50% or higher, so that we're going to try to get things. I'll give you some examples.
Yes.
We own probably 7 or 8 preferreds that all yield between 5 and 3/4, 6%. We own 4 pipelines that yield 7.5 to 9%. We own things of that nature. We will own short paper too and mix it with those things for the time being. One of the things about a bear market is you are not going to be able to really, most investors will not be able to really not have any loss at all. But what you try to do is really manage it. I mean, if we're down, I remember back in the 2000 period, we were down about 10% overall for the 3-year period. Markets were down almost 50 or maybe 50.
Yeah.
Well, you can come back really quickly from 10. But when you're down 50, it's going to take you a long time because you got to make 100%. So what you try to do in these markets is you try to manage the risk and don't get too caught up on, hey, I'm down to a 3 or 4%. Yes, you are. But you know what? You're not down 25. And I think that's where people have to keep their head on here, because that's the difference in trying to keep a realistic approach to what a bear market really is.
Okay. How do you feel about hedging? For example, I'll just give you one example, buying a long-dated put option on one of your positions. Would you consider doing that?
Well, I will tell you what we do. That's a little different than most people, but rather than take major capital gains, because we have some things that are really big profits over the last 10 years, and rather than take, and we're over 51% or so in the equity account, but part of that 51%, I will tell you how we get there, is we have about a 7.5%, about a close to 8% position in the short S&P. And rather than take those capital gains that are so large, okay, and we're going to pay a major piece of tax on it, what we try to, and we want to own those companies still. So what happens is we will hedge out and use that, really, we use it as a cash position. It's up in price for us right now because we put it on, early in the year. But that's what we do. We're not big in the put market or the call market either, for that matter, but that's how we do it.
How do you feel about consumer staples? Traditionally, they've done well during recessions. Take 2008, for example. During 2008, 2009, Walmart was up 20%. How do you feel about these big box stores now?
Well, I think what's happening with them is, and I think people forget about this, but most of the people that go to, they do the consuming are people that are really starting to hurt in terms of cash flow. And I think that has more to go. I mean, you've seen Target and Walmart and the numbers come out. They've been, disappointing. We don't own those stocks, but there's a time to own them. We don't think it is right here. I mean, there's only the things that get you through bear markets, you have to be careful of cyclicals. You have to be careful of those sorts of things. You can see things like, a little bit of healthcare. You can see things where, maybe a Visa, MasterCard, that kind of thing, where you've got to make transactions, that sort of thing. But the consumers will pull back and probably pull back even more. So we don't do too much in that area right now, other than what I just mentioned.
Another way to hedge, I guess, people have talked about owning hard assets during recession, so precious metals and or real estate. How do you feel about either of these assets?
Well, we own the real estate investment trust, but we only own medical REITs right now. We really feel like that if you look at commercial REITs and you look at industrial REITs, they're starting to weaken. And so we own a couple of medical REITs, and then we own a REIT that has convenience stores. We feel like we're okay with that. I mean, that's something that keeps on moving. But that's where we concentrate. I don't think real estate in itself is going to be the greatest place, but we do own those for sure at that point, and that's something we have in the portfolio. We'll say this about the metals. Yeah. We have three strategies: in the really conservative strategy and the higher income strategy. We own about 4 to 5% gold. And we own that. We will not sell that. New accounts get that as well. And I think gold is sort of a sleepy time right now. But people own gold when they get scared, when they get worried. And I think the worry and the scare is ahead. Gold sometimes is weaker in the summer anyway. But we think you have to have a little gold in those types of portfolios.
Okay, so you're using gold as a hedge against heightened risk, is more or less your plan?
Well, and the dollar. I mean, what typically happens, David, is that when the dollar declines, and the dollar's just been on just a big run, and that's one of the problems with gold. But when the dollar does decline, then you'll see gold, it'll go the other way. And it tends to go with the bonds too. You get bond rates coming down eventually. And you'll see gold as well. But right now, I think the thing about it is that it's sort of, I'll call it a fear asset. I don't think you can look at gold we don't look at it as inflation, deflation. We just think there's 2 or 3 things that affect it. One is a dollar, and one is when people really get worried, they look at gold.
Interesting. Okay. Well, finally, I'd like to talk about some long-term trends that people, not just investors, but everybody should be concerned about, which is the standard of living across America. Inflation is high. People are concerned about their wealth being eroded. This is an interesting study I read on CNBC. I'll just read the headline in the first paragraph. Gen Z is stashing away 14% of income for retirement. So young adults, defined in the study as those aged between 18 to 25, are storing away on average 14% of their income for the retirement years, according to a research study done by BlackRock. That compares with only 12% for their older counterparts, millennials, and Gen Xers and baby boomers. So, interestingly, the youngest generation, the youngest adult generation alive today, according to the study in America, is saving more of their income for retirement than the older generations. I think that there are a few ways to interpret this. One is that they're just not very confident about their retirement years, even at the young age that they are. Or two, maybe they're just earning more than everybody else right now, and they have more to stash away. Why do you think younger people are saving more money these days?
Well, I think a number of things go into that, David. Number one, a quarter of them are living at home.
Okay.
So they don't have any cost, okay?
That's a fair point.
and then a lot of the rest of them are working from home. So their costs are down as well. And the other thing, and I just notice this amongst parents, I mean, what I see from them a lot is, especially with these Gen Zs, they're like, okay, I want to make sure they're okay. So I'll take care of your insurance, or I'll take care of the car. I'll get you a new car. I'll do something. That's what's going on right now because of the wealth effect of the parents. Now you let that wealth effect go away, and that 14% going into retirement probably changes as well. But those I think that's what gets you there.
Okay. Generally speaking, though, looking ahead, do you think younger people can afford homes? I'm just looking at just the other day, I was looking at the numbers. The median home price to income ratio in the U.S. is now 8. So it costs you 8 years of salary to buy one home. Back in the early 2000s, that was around 4. This number currently 8 is slightly higher than the 2008 housing bubble at the peak. So it is very expensive on an income comparison level. What does this mean for the future of home ownership in America?
Well, it's obviously going to be harder for them because not only is the home higher, but that means the insurance is higher, and it means the taxes are higher. So all of that put together makes it tough on them. And I can't see any way that, I'm not saying you get a crash maybe like you did in 06, 07 going into 08. That was tough. That was big because of subprime, but you may be in a situation where it breaks down to a certain level and it stays steady, and you have to wait until incomes catch up with where that lower price is. And that may take 3 or 4 years. You may be in a period where it's just under investment in that area and they finally catch up. But that's usually what you see. We sort of were like that back in 1980 and 81. You had 18% mortgages. And the idea was you'll never be able to buy a house, but we all figured out ways to borrow money on the side or get somebody to do something to help you, and you got into a house. I think they'll get there one way or the other, but it's probably a slower process than it was before.
There's this timeless debate whether or not whether it's beneficial to own a home or whether it's more economically sensible to rent. Help us out with this debate, Ted.
Well, I think a home is HOME. It's a home. It's not, to me, living in an apartment is a house. It's not a home. A home is something that you put your heart and soul into, and you decide how you're going to make it for your children. And that sort of, if you have children, if you don't, that's fine too. But it's you and your partner or whatever, that's what you develop into a home, and you make it something that you always come home to. And there's a certain amount of what I call serenity and solace about that, where you come to a place that you can like. I think the problem about living in apartments and renting is that you don't have the ability to make the ownership on the outcome of what's going to happen to you. And that's the difference in the two. And yeah, it may be cheaper, but it's still not a home.
Interesting. All right. Well, definitely follow up on that. And I'd like to ask you more questions about personal finance and life advice. Thank you so much today for coming on. Thank you, Ted.
You bet, David. Thanks for having me.
All right, and thank you for watching Kitco News. I'm David Lin.